Happening on January 20th and 21st is Denver's biggest real estate event, the Next Big Thing. And it's shaking up how real estate professionals will define business success. This two-day event will give you tools so you can catapult your own business. You'll discuss how the world is changing and what's needed to stay 2 steps ahead. Together with 450 other professionals, you will build a foundation to become the next big thing. Built on the foundation of helping others build wealth through real estate, the Ruth team has created the ultimate tool that is this event, and it's called the Next Big Thing. 25 speakers, including Ryan Serhant, Kenyon Salo, Nebu Hatta, Stacy Veeden, Brian Moses, Natalie Davis, and Ryan Avery. Register now at thenextbigthingcolorado.com and use the code RESS to get $150 off. Merry Christmas from LifeBridge Capital. I'm Whitney Sewell, CEO and founder, and wanted to bring you this weekly investor update for the week of December 19th through the 25th. Don't forget to like and subscribe to the show. Whether you watch it on YouTube and listen there, or whether you're in the car, I hope that you will share it with your friends as well so we can help them to learn more about investing in real estate and through the syndication business. But let us know of anything that you would like us to add to this report that would be beneficial to you. Here are some highlights from this week's real estate market. Single-family housing market rises, while single-family rents rise 3 times as fast as last year. Mortgage rates fall to 4-week low, and homebuyer competition becomes the lowest in a year. November home sales rise due to stronger job market. Even as we're in the usually slower season for housing demand, builder sentiment in the single-family housing market rose 1 point to 84 in December on the National Association of Home Builders and Wells Fargo Housing Market Index. Analysts were surprised that the increase comes despite concerns over inflation, material delays brought by the supply chain disruptions in the construction industry, and the ongoing labor supply shortage. The NAHB is expecting single-family starts to reach 24% higher than the pre-COVID 2019 level, which is fueled by the build-for-rent sector. Single-family build-for-rent construction achieved its highest quarterly volume in the third quarter of 2021. However, the group also believes higher interest rates in the coming year will negatively impact housing affordability and reduce the steam in housing starts. Single-family rents in October were up 10.9% year over year, according to the latest report from CoreLogic. That is 3 times the 3.2% annual growth seen in October of 2020. The faster pace of rent hikes is influenced by the strong activity in the build-for-rent market. Lower priced properties are being turned into rental housing, pushing new home buyers who can't compete with cash buyers from real estate investors. Miami had the highest year-over-year increase in single-family rents at 29.7%, followed by Phoenix and Las Vegas at 19.3% and 16.5%. San Diego and Dallas also made the top list. CoreLogic is expecting the momentum to taper off with more rental housing supply coming next year unless demand skyrockets, brought by the impact of the Omicron variant, forcing people to relocate to suburbs where single-family rentals are plentiful. In other news, more interested buyers, but less buying activity. That's what the mortgage and property markets are likely to be in the first quarter of 2022, according to analysts. The average contract interest rate for 30-year fixed rate mortgage with conforming loan balances decreased to 3.27% from 3.3% in the previous week, according to the Mortgage Bankers Association seasonally adjusted index. With this, applications to refinance a home loan increased 2% from the previous week, but were 42% lower year over year. Refinance applications are known to be highly sensitive to weekly rate changes. But according to brokerage firm Redfin, the fall in mortgage applications is an indicator of a lower number of homes actively listed for sale, matched by rising property prices and not necessarily a lower interest in home purchases. The MBA also commented that loan activity was mostly observed on the higher end of the market, where the average purchase loan reached $416,200. Hey guys, it's Whitney. I wanted to take some time to introduce you to my good friends over at Passiveinvesting.com. They're a national private equity real estate firm based out of the Carolinas. They focus on acquiring institutional quality apartments and self-storage facilities. They do this with private accredited investor funds. They have a portfolio of over $700 million in assets and control over $250 million in equity from their investors. Passiveinvesting.com makes it easy for you to start investing in real estate without all the hassles. They even have an average 62% repeat investor rate in each offering they put together. They even have a real estate debt fund that offers hard money loans to local fix and flippers across the U.S., which currently has a 0% default rate. To help you learn more, they've put together a free passive investor guide that outlines the 7 red flags for passive apartment and self-storage investing. Visit passiveinvesting.com/red flags to download the PDF now. That's passiveinvesting.com/red flags. In connection with the report, Redfin also noted that home offers bidding wars in November dropped to only 59.5%, the first time the competition rate was below 60% since December of 2020. According to the group, this trend follows a typical seasonal pattern where the winter season forces buyers to take a momentary halt in bidding for homes. Still, it predicts that home buying will be stronger in the coming year despite the shortage of homes for sale. Richmond, Virginia had the highest bidding war rate among the 44 U.S. metropolitan areas in the study, with 80% of offers written by Redfin agents facing competition in November. It was followed by Salt Lake City at 73.8%, San Diego at 72%, Honolulu, Hawaii at 71.1%, and Dallas at 70.6%. The lowest competition was observed in Jacksonville, Florida at only 33.3%. Meanwhile, sales of previously owned homes in November rose 1.9% from October to 6.46 million units, according to the National Association of Realtors seasonally adjusted count. NAR's report also observed month-to-month sales increases in the Midwest with 0.7%, in the South with 2.9%, and the West with 2.3%. The Northeast, however, remained the same. NAR's chief economist, Lawrence Yun, states that while new listings are hitting the market, they're quickly sold to investors looking to profit from the build-to-rent sector. The tight supply has impacted the median home price, rising 13.9% month over month in November. Home sales of new listings reached 1.1 million due to a better job market and concerns of higher interest in 2022, which accelerated buyers to act quickly on their purchase plans. Meanwhile, exiting condominium and co-op sales were recorded at a seasonally adjusted annual rate of 710,000 units in November, up 4.4% from 680,000 in October to equal to 1 year ago. The median existing condo price was $283,200 in November, an annual increase of 4.4%. And that's it for this week's highlights. I hope you have learned a lot and enjoyed the updates. We would love to hear from you at info@lifebridgecapital.com on anything that would benefit you as an investor. Please like and subscribe, leave comments. We look forward to working with you at LifeBridge Capital. Merry Christmas.